All right, more reaction to the sell-off. We got Peter Barisi, University of Maryland economics professor. Peter, I think it was Lenore that was mentioning the fact that there was talk down of the dollar going on from Davos last week. That wasn't very helpful to the overall market. I understand why our Treasury Secretary was talking down the dollar. That makes assets in the United States cheaper. He was trying to get businesses, foreign businesses, to move here, to build new factories here, et cetera, but it really was not helpful for the market. And coincidentally or not, in 1987, right before the October crash, the Treasury Secretary then, James Baker, was talking down the dollar, and that led, or some people say that triggered the crash then.
That's true.
Is that
That's
a
true.
problem this time? Should the Treasury stop trying to talk down the dollar?
Well, I think the Treasury right now should keep quiet about the dollar. And it's unfortunate that the market reacts in ways that don't make economic sense. For example, if the dollar were a bit weaker and exports were cheaper and imports were a little bit more expensive, that would be good for U.S. growth. And we need more growth. Don't believe that Atlanta Fed number. Economists watch that thing, but basically they come up with a new estimate every week and it goes up and down. That's an estimate of what they think first quarter growth will be, and we're only 1 month into the quarter. We have not been growing at 5.4%.
No.
They just basically read those high Institute of Supply, the ISM numbers.
But without getting too into
interpreted
those numbers, the fact is, Peter, we haven't seen the full effect of the tax cuts yet. We haven't seen all that money come back. We're expecting probably as much as $1 trillion, if not more so, in terms of repatriated capital. Once that starts churning in the economy, won't that lead to greater growth and more stock buybacks and higher stock values?
It certainly will, but I wouldn't count on a lot of that money coming back. They're going to pay taxes on that money, but they're going to leave it where it does the most good. Remember, somebody like Apple's already got a flush balance sheet. They don't need any more money here. And that applies to many companies.
But hold on a second, because they've already paid, Peter, we know they have already paid off a lot of those, the taxes on that foreign capital in the last quarter. We've seen that in a couple of the reports that were issued last week. Go ahead.
They have to pay the tax, whether they keep it there or bring it home. They have to pay the tax.
But why wouldn't they bring it home?
Well, the point is where do they need it? If their balance sheets are already flush, there's no reason to. And remember, that money's not just sitting around in a savings account at Deutsche Bank. A lot of that money's invested, and they'd have to sell off investments. The money will come back, but it won't come back in a rush.
But here's the idea, Peter. Forgive me for interrupting, but the point is you invest money in what you think is going to grow. And if you think the whole U.S. economy is going to grow because of the tax cuts, consumers will have more money in their pockets. They're already more confident about the economy, so they're going to buy more things. So that's why companies might invest more here in factories and growth, et cetera.
Absolutely, and I agree. We're on the same page. What we're differing on is the pace of the flow back. They have to pay their taxes all at once, but they can bring back the money as they please. As you know, it takes time to plan a building and put it up.
Right.
But that's just one factor. There are other things going on here that are very, very significant. One is the deflation of the Chinese stock market. The Chinese government's been trying to bring down the bubbles over there for quite some time, and now they're having some success. Well, guess what? Markets are linked. Another thing is there has been this kind of misinterpretation of Fed intentions. They're going to gradually raise interest rates to levels that are well below historic levels for an economic expansion. They're talking about a top federal funds rate of 3%. And it doesn't mean that there's inflation outside. Last month we had 2.9% wage growth. Even with Barack Obama-era productivity growth of 1% a year, that translates into 1.9% inflation.
Right. Before we get too into the numbers, Peter, I just want to ask very simply, what do you think is going to happen? Have we gotten it out of our system, or is there more carnage yet to come in the market?
There's more carnage to come, but the market will recover. We're going through a correction, which is long overdue. If you recall, about 10 days ago, if you read the Wall Street Journal, everybody was saying the market could only go up.
Right.
That's the surest sign that things are going to go wrong.
That's right. Everybody was absolutely positive about the market. That's kind of dangerous. Go ahead, Peter. Final word, quickly.
The other thing was the big technologies recorded record revenues and profits, but there was a lot underneath the balance sheets that indicated they'd have trouble repeating. Now, I think they will fix their problems and meet their challenges, but there are a lot of headlines around the world that indicated that big tech disappointed. We've been riding them very intensively up this market. They've been the lead horses, and now we can't expect that from them quite so quickly, quite so soon.
Gotcha.
But this market will turn around.